Let's talk about the international securities market. It sounds complicated, right? But it's really not. Imagine a giant marketplace where companies and governments go to raise money. That's the ISM in a nutshell. This market is where stocks and bonds from all over the world are bought and sold. It's a vital part of the global economy. Why? Because it allows money to flow freely across borders. Think of it like a global flea market, but instead of selling old furniture, they're selling pieces of companies and debts of governments. And just like any good flea market, it's a place to find unique opportunities. Now, you might be thinking, Suze, this doesn't apply to me. I'm not a big corporation, but you'd be surprised. Your retirement fund, your bank, even your favorite store, they could all be players in this international market. Let's say a company in Japan wants to build a new factory. They need a lot of money, more than they can get in Japan alone. So they turn to the ISM. They can issue bonds on the ISM, which are essentially loans from investors around the world. Or they could sell stock, offering a piece of their company in exchange for cash. Governments do the same thing. They need money to build roads, schools, and hospitals. They can't always raise enough through taxes, so they issue bonds on the ISM. This flow of money is crucial. It allows companies to grow and expand internationally, and it helps governments fund important public projects. Without the ISM, our world would be a very different place. Businesses would struggle to grow. Economies would stagnate. It's that important. But like any financial market, the ISM has its risks. It's important to understand how it works before you jump in. Now, let's talk about the different types of securities traded in the ISM. There are three main types: loan instruments, ownership instruments, and derivatives. Loan instruments are pretty straightforward. It's like lending money to a friend, but on a much larger scale. You lend money, and they promise to pay you back with interest. Bonds are the most common type of loan instrument. Ownership instruments, on the other hand, give you a piece of the pie. When you buy stock in a company, you're buying a small ownership stake. If the company does well, your investment grows. But if the company struggles, you could lose money. Derivatives are a bit more complex. They're like side bets on the performance of other securities. For example, you could buy a derivative that increases in value if the price of gold goes up. Derivatives can be risky, but they can also be used to hedge against risk. Understanding the different types of securities is essential for navigating the ISM. Each one has its own risks and rewards. Don't put all your eggs in one basket. Diversify. Section 4. Loan versus ownership. What's the difference? Now, let's dig a little deeper into the difference between loan instruments and ownership instruments. This is important. When you buy a bond, you're acting as a lender. The company or government owes you money. They have to pay you back even if they're not making any money. That's why bonds are considered less risky than stocks. But remember, less risk usually means less reward. Bonds generally offer lower returns than stocks. They're like the tortoise in the race, slow and steady. Stocks, on the other hand, are like the hare. They have the potential for high growth, but they also come with more risk. You're not guaranteed anything as a shareholder. Which one is right for you? It depends on your risk tolerance and your investment goals. If you're young and saving for retirement, you might be comfortable with more risk. But if you're closer to retirement, you might prefer the stability of bonds. Remember, there's no right or wrong answer. It's about finding the right investments for you. Section 5. Two sides of the same coin. Foreign securities and the euro market. Now, let's talk about the two main segments of the FMEL, the foreign securities market and the euro market. The foreign securities market is where securities issued by foreign companies are traded. For example, if you buy stock in a Japanese company on the New York Stock Exchange, that trade takes place in the foreign securities market. The euro market is a little different. It's a market for securities issued and traded outside the country of the currency in which they are denominated. Confused? Let me explain. Let's say a US company wants to issue bonds in US dollars, but they want to sell them to investors in Europe. They could issue euro-dollar bonds in the euro market. These bonds are denominated in US dollars, but issued and traded outside the US. Both the foreign securities market and the euro market are important parts of the ISM. They allow investors to diversify their portfolios internationally and access a wider range of investment opportunities. Remember, diversification is key to a healthy portfolio. Don't put all your eggs in one basket, especially when it comes to international investing. Section 6. The engine room. Demand, supply, and more. We've talked about the what of the ISM, but what about the how? What makes this market tick? Just like any market, the ISM relies on the basic principles of supply and demand. When demand for a security is high, its price goes up. When demand is low, the price goes down. But there's more to it than that. The ISM also relies on a complex network of intermediaries, including banks, brokers, and clearinghouses. These intermediaries facilitate trades, provide liquidity, and help to ensure the smooth functioning of the market. They're like the gears that keep the engine running. Of course, no market can function without rules. The ISM is regulated by a patchwork of national and international bodies. These regulators aim to protect investors, ensure market integrity, and prevent financial crime. It's a complex system, but it's what allows the ISM to function effectively and efficiently. Section 7. Reaping the rewards. Benefits for all. So, we've covered a lot of ground. We've talked about what the ISM is, how it works, and who participates in it. But why does it all matter? What are the benefits of this global marketplace? For companies, the ISM offers access to a vast pool of capital. They can raise money from investors around the world, allowing them to grow and expand their operations. This access to capital is crucial for innovation, job creation, and economic growth. For investors, the ISM offers a world of opportunities. They can diversify their portfolios internationally, reducing their risk and potentially increasing their returns. They can invest in companies and industries that may not be available in their home markets. But the benefits of the ISM extend beyond individual companies and investors. It facilitates cross-border trade and investment, promoting global economic growth and cooperation. It allows countries to share risk and finance essential public projects. In a world that is increasingly interconnected, the ISM plays a vital role. It's a complex and ever-evolving market, but it's one that offers tremendous opportunities for those who understand it.